G'day Year 12 and welcome to another YouTube lesson. Now today we're going to be taking a look at our last lesson of monitoring and controlling your finances. And a reminder that monitoring is looking at planned results and comparing them to actual results, and controlling is then doing this and also taking corrective action. Now we're going to be looking at a balance sheet. I want you to have in your mind, we've done a bit in class already, what a balance sheet is, right? A sheet that balances. Okay, down the bottom, they total each other. Okay, we're going to be taking a look at a balance sheet and how it's a tool for a business to be able to monitor and control. And as I often say, I want you to be able to put this in perspective or in place where it is in the syllabus. It's very important. We're doing finance at the moment, not HR, not operations, not marketing. We're not doing influences inside of finance. We're not doing influences or strategies. We're looking at operations. Operations are those set of steps that an operations manager, that a financial manager, an operations manager goes through in their day-to-day tasks. All right. So as I said, this lesson will be looking mainly at balance sheets. It's a tool, a method to monitor and control. Previously, it was like a trilogy, I said in the first one. In the previous two lessons, we look at the other tools, the other financial statements as methods to monitor and control. That first financial statement we looked at 2 lessons ago, so if you remember, you set a cash flow statement, you've done well. The last lesson that you may have just looked at, maybe looked at a little while ago, was another financial statement, another tool. You remember what that was? You set an income statement, which is a revenue statement or profit and loss statement, you've done well as well. Okay, so in terms of a balance sheet, all right, as I said, it's another way to monitor a business's and control a business's finance. All right, this financial statement looks at the current assets of a business. So on your left-hand side, I'm not sure which is the left-hand side in terms of you guys looking, but on my left-hand side, you have your current, you've got your assets. All on that left-hand side. You've got your current assets and your non-current assets. On the right-hand side, and this is my right, on the right-hand side, the top half, or top 2/3, are your liabilities. You have your current liabilities up the top and your non-current liabilities underneath that. Right down the bottom, you have your equity, or your owner's equity. All right, and I'm going to go through what each of these particular things mean, give you some examples so you understand how it works. But the biggest thing you need to understand, and look, most of you probably get it, but you know, if you're not really financially minded or it just hasn't clicked, then you might not understand why it's called a balance sheet. It is a balance sheet because your total assets on the left side equals, say, $250,000, then you know it has to on the right hand side, all your liabilities plus your total equity or your owner's equity, okay, that has to equal how much? $250,000. Not surprisingly, it balances, right? How do we figure out it balances? How do we know it balances? There's a thing called the something equation. What do you reckon it might be? Accounting equation. If you got that, well done. You have your assets on one side equal to your liabilities plus your owner's equity. So if you're given your total assets, say it's $1,000, and your liabilities you're given as well, your total liabilities, current and non-current, is say $4,000. So $10,000 for your total assets, $4,000 for your total liabilities. You already know your owner's equity, even if nothing's there, because the difference between it's $6,000. $4,000 plus $6,000 liabilities plus owner's equity has to equal the $10K in assets. It's just straight out basic algebra and maths. All right, now let's get into the nitty-gritty a bit of the balance sheet. Now, on your left-hand side, you have your current assets. There's 3 main things, 1, 2, 3, that we tend to see in your current assets. You got your cash, okay, that might be $7,000. This is your coin in your bank account. Now, I say coin, cashola. It's most of these days not physical cash. All right, it's usually electronic cash in your bank. All right, like the stuff you'd see in your cash flow statement. All right, on top of that, you have your accounts receivable. That's also part of your current assets. Now, your accounts receivable is potential cash. I'm Bunnings, or carpenters, plumbers, I was saying lawyers, but I don't think they come too often to Bunnings. You know, you've got all these trades who come to Bunnings and they take stock. They take, my nails, the screws, the hammers, the piping. They don't pay for it straight away. I invoice them, send this receipt type thing, and say, right dude, right lady, person, whoever. I don't know if that's PC these days to say it that way, but come and, you need to pay me this amount of money. So while I'm waiting for it, it's called my accounts receivable. They're meant to pay it to me. It's their accounts payable. So that's also part of current assets. You have your inventory. Another name for inventory is stock. It's money that you have in terms of stock on the shelf. Okay, so if I'm Bunnings again and I have all these hammers lying around and they're worth $10,000, all right, if I was to sell them, I get 10K, then that's the inventory, the stock we've got. All right, those three things make up the total value of our CA, our current assets. Now, current assets are usually, depending on the textbook, something that you have as cash, i.e. cash, or can turn into cash. It's liquid enough to turn into cash within a 1 year time frame. Non-current assets are the next thing on the left-hand side. And while I'm going through this, it's not a bad idea if you've got your textbook there, all right, or your workbook, and you're taking a look at, a particular balance sheet. See what I'm talking about to visualize it. But I like you to do it in your head. I think you'll learn it better if you can remember it. Non-current assets, you've got a number of things, but three key ones you could have. And these are assets that you don't tend to convert to cash very often. That's why they're called non-current. So something you would never convert to cash, or something that you would only convert to cash on average over more than a year. So we have a company car, could be one, or vehicles, often they say, maybe 35,000. Equipment, so inside a classroom, you got the smart board, you've got tables, it's great equipment, but tables and chairs, those type of things, all right. And inside a business, you might have like the art of gelato, you'll have the pasteurizers, those type of things, all right. They are the equipment. You don't sell them each day unless you are a business who makes and sells pasteurizers, all right. So you generally have them there for a substantial period of time. Now, the last non-current asset I'll mention is land and buildings. So factories, the land itself, that's something you don't tend to sell often unless you're a real estate agent. But for the most part, that's your own land and building, and it's something you keep for a substantial period of time. The total of both current and non-current assets, they're called total assets, and whatever that adds to, rest assured, on the right-hand side, it's going to have to be the same. Let's go to that right-hand side. You got your liabilities to start with, current and non-current. Now, your current liabilities, you have a bank overdraft, or an overdraft usually, all right, and that might be $5,000. Now, your overdraft quickly, it's like having a normal savings account for a business with a little bit extra. Okay, my savings account might have $3,000 in it if I'm a business. I am awesome business, that's my business name. Correct. Now, let's say that I have a bill that's worth $10,000. I'm $7,000 in the debt, $7,000 in the red. How am I going to pay for that? Well, if I have an overdraft facility that allows me to go $20,000 into debt, that's no problems. I don't even have to ask once it's set up. Okay, $3,000 they take out of my savings, and then I owe a $7,000 bill, so $4,000, just my account, my overdraft facility goes into debt $4,000. It's high rates of interest, all right, similar to sort of a credit card, but a bit lower, all right, but it's still not ideal, but it does serve a purpose for liquidity and in particular cash flow management. Not working capital as much, but more cash flow management. Okay, another type of current liability are your accounts payable. What are these? I talked about the accounts receivable. This is just the opposite. I'm a carpenter in this instance. That person over there, that business over there, okay, beyond my laptop is Bunnings. I've come and got, nails, hammers, screws, those type of things. If I'm the average person, not a carpenter, not a tradie, I have to pay for it each time I go to Bunnings. If I am a tradie and I go there all the time, they allow me to get store credit, trade credit, okay, to be able to take the stock and pay for it at a later date. They'll send me an invoice, Bunnings, and I'll then pay that. Say my accounts payable $17,000. In 2 months, 1 month, 3 months, whatever Bunnings and I agree to in terms of the invoice, I pay them that amount of money. Now, until I've paid that money, it's a debt I owe. It's a liability, a short-term one, so it's on my balance sheet. Now, the next one we've got there is the non-current liabilities. These are loans that you have for usually greater than 1 year. The current liabilities, I didn't mention before, but they're usually debts or liabilities, loans that you have for less than a year. All right, so 2 are non-current liabilities you could have, but there's a range, you have more. Mortgages, mortgage loans, maybe debentures. Now, mortgages, that's what most of your parents probably would have on their home. Not everyone has a mortgage. Do your finance as well and you pay your joint off? Oh, thank you. Now, in terms of a mortgage, this is when you purchase your factory or your house, but for a business, it's shop premises perhaps. And what they'll do is the bank will give you the loan for that, but they have your house as security. So that if you can't make repayments because you lose your job or whatever, or your business is going under, all right, they've got to give you plenty of chances and warnings, but the bank can actually sell that factory, that house, and recoup the costs of that loan. So it's secured against the loan, against the actual factory or the house or whatever you may have taken out. You make payments as a person having the mortgage taken out over often 20, 30 years. You generally, unless it's interest-only mortgage, but they're very rare or rarer these days, tightening up of loans. You make repayments over 20 to 30 years and you eventually pay off the principal. Okay, but you're paying off the interest much more off at the start. Now, the other type of non-current liability are debentures. Okay, and debentures are when you go and ask in the marketplace, usually get a bank to do it for you, and it'll be a case of borrowing surplus funds from other businesses for a fixed rate of interest, for a fixed rate of time, okay, and you will then pay back that money in full, and also that you took from the debenture, and also the interest applied to it at that specified date. All right, now these are also another source of long-term finance. We looked at that, so go back to debentures if you need to, but it's part of the non-current liabilities if you've got them out. Not all businesses have them out. Now, the last thing on your balance sheet is your equity or your owner's equity. All right, it's often the heading. There's usually 2 things you see in equity, but sometimes drawings as well. I won't get into drawings today, it's a bit complicated. So under your owner's equity, your equity, it's the bottom thing on the right hand side. You have your capital, right? Your capital is the cash holder you have in the business. So what you've invested to start with, 100,000, $1 million, whatever it may well be. Yeah. Okay. You also have your retained profit, or sometimes called net profit. Same, no diff. Okay, exactly the same thing. So it might be $28,000. This is how much profit the business has made and kept there in the business and hasn't given to dividends to the shareholders. All right, so you get your total of your equity, in this instance capital, plus retained profit. Now you need to, on that right hand side, to get that same 250K, plus up all your short-term, long-term debts or liabilities, is your current and non-current liabilities, and you need to plus with that right-hand side total owner's equity, and that will give you guaranteed, or there's a mistake somewhere, $250,000. All right, guys, the last thing we need to take a look at are, very quickly, so you've been patient, 3 ratios that apply to a balance sheet. You can find your current ratio by looking at your balance sheet, and your current ratio or liquidity ratio, it's another name, so your current assets divided by your current liabilities. You can find your debt to equity ratio, and that is your total liabilities or debt divided by your total equity, and we times it by 100 to get the percent, and return on owner's equity ratio, which is your retained or net profit divided by your total owner's equity times 100. All right, guys, thanks for listening. See you next time.